Last few weeks were characterized by two events. First, India did something unthinkable by delivering a stunning outperformance vis-a-vis global markets as well as emerging markets. Second, Indian G6, uh, the yield crashed from 7.6 odd levels to about 7.2 in a very surprising manner, while the yields globally were going up. On the face of it, these two events may seem unconnected, but if you dig deeper, you will see some patterns emerging. Let's dive in. Hi everyone, welcome to our monthly video post. In this video post, we are going to be exploring this very fascinating question. The current decoupling one is witnessing in India, is it here to stay or will it recouple? So let's look at first the Indian markets outperformance. When the global markets have been going down, India has charted its own course since the first week of August by going up. With its surreal surge, Indian markets have really surprised even seasoned investors. Let's look at some of the data points. Since the first week of August, MSCI Global Index is down by about 4.9%, and MSCI Emerging Market Index is down by over 4%. In the same period, Indian markets have moved up by 2%. That's a stunning outperformance of 6%. Looking at the other way, from June lows, Indian markets, I think the Nifty is up by about 12%, while the globally Dow index is flattish and Nasdaq is about 3.3% up. So overall, I think even if you look at from June lows, the outperformance levels are very, very significant. So what's happening? This has made some of the investors to rush and call this as age of decoupling for India. As per them, the favorable geopolitics for India and the turn of profit cycle for India has made, enabled India to decouple very strongly from the rest of the global markets. Historically, if you look at upcycle or downcycle, it is always the developed markets. US in particular has always set the tone and emerging markets have followed the course. It's very unusual for any emerging market to stand out of what's happening in the developed markets. This has been the case across many cycles for India. It's extremely difficult for us to recollect any single cycle in the past in which India is decoupled in a very sustainable manner to what was happening or what's happening in the world. So it was always one of very tight coupling between India and the developed or emerging market. But in this cycle, it has been different. Though initial part of the cycle, India was tightly coupled. Of late, there is a sense of disconnect between what's happening to Indian markets and the rest of the world. So is this decoupling for real, or India will soon recouple? That's $1 million question, and this is giving sleepless nights to some of the seasoned investors. In this, it is prudent for investors to keep a very balanced perspective. Though India's macro is at a relatively sweet spot, with a very attractive growth cycle, stable forex reserves, and superior profile of external debt. But in the short term, it is extremely difficult for any emerging market to stand out and shine, given the global linkages and the spillover effects of Fed tightening and rising dollar. So given this, it is not easy for any emerging market to decouple in a sustained manner, especially when the global macro is at a difficult spot. Also, if we go back and look at our introduction, we talked about the fall in the G-Sec yield in India. And this has nothing to do with decoupling. This is more to do with the rising chorus in terms of India joining the global bond index. So probably markets is building up in anticipation of expected inflows into the bond markets if that event were to happen. So this needs to be kept in perspective, not to be linked to the decoupling noise which is slowly emerging for Indian markets. So overall, from the perspective of what's happening to the equity as well as the bond markets, I think it is prudent for investors to assume that the short-term volatility is here to stay, especially when the Fed is likely to accelerate the tightening cycle, given the challenging outlook, given the challenging inflationary outlook for US. So in the short term, investors should expect volatility to continue. It's very unlikely that India will decouple in the short term, given the reasons which we mentioned above. At the same time, in the medium to long term, or when you look at the medium to long term outlook, India will continue to stay as one of the relatively safer and sweet spot for global investors. So what it tells you is, when the dust is settled, when the short-term volatility is digested and weathered, India will come back and outperform very, very significantly the global and the emerging markets. So given this robust medium and long-term outlook, investors can use the volatility and the corrections which will happen on the way to their advantage by building or adding to their portfolio positions. And that's what investors should do, because the medium to long term outlook is looking really robust for India. Happy value investing. Thanks for watching this video. If you like this video, please do post your likes to our YouTube channel. And if you want to receive our regular posts, please do subscribe to our channel. And any feedback from our subscribers are welcome. Thanks once again for watching this video, and see you in the next. Thank you.